Hi, I'm Suneel Maheshwari, Professor of Accounting at Eberly College of Business, Indiana University of Pennsylvania. Today, we'll be talking about the difference between cash basis and accrual accounting, and most of the time will be spent upon accrual accounting and understanding the adjusting entries that are needed in an accrual accounting system. In an accrual accounting system, as opposed to the cash accounting system, you record the impact of transaction when it occurs. It is required by GAAP, and expenses are recorded when incurred, and revenues are recorded when earned. As opposed to the cash basis accounting, when you record only if you receive the cash or make a cash payment. And cash basis accounting is generally used by smaller businesses only. Otherwise, most of the companies use accrual. The word accrual literally means to happen. So whenever the revenue takes place, revenue is earned or expense is incurred, you record it so that you're able to record the revenues of a period in that period and the matching expenses in that particular period, which have been the expenses that have been incurred to generate those revenues. So accrual accounting will records cash transactions such as the following. You're collecting cash from customers, receiving cash from interest earned, borrowing money, paying off loans, and issuing stock. We will go into each of those transactions and explain how it differs from the cash basis. Now, accrual accounting will also record the non-cash transactions like sales on accounts, purchase of inventory, depreciation expense, or usage of prepaid rent, insurance, and supplies, or earnings of revenues when cash was collected in advance. So as far as the accounting is concerned, we follow the time period concept. That is, although the life of the business is infinite, you divide that life into regular intervals of 1 year or so. And most of the companies use January 1 through December 31st as their fiscal year. Fiscal year may end on a date other than December 31st if needed, especially for companies that have cyclical businesses. Companies might prepare interim financial statements on a monthly, quarterly, or a semi-annual basis as well. Now coming to one of the most very important concept of revenue and expense recognition. Revenue recognition deals with two issues. That is, one, when to record or recognize the revenue, and second, what amount that revenue should be recorded at. As far as the international standards are concerned, that has much simpler revenue recognition criteria. The selling entity must identify the contract with the customer. They must identify the separate performance obligation in the contract, a transaction price, and then allocate the transaction price to the separate performance obligation in the contract, and then recognize revenue as the entity satisfies the performance obligation. So once the obligation is satisfied by the entity can record it as a revenue. So here is an example. Now, here's a customer which says, I plan to start drinking Starbucks drinks. And Joe at Starbucks, great, we will welcome you as a customer. Now, can the revenue be recorded when the customer just thinks about of buying goods from from Starbucks? No, it cannot be recorded as a revenue at that time. Similarly, it cannot be recorded when the Joe at Starbucks says that we will welcome you as a customer, because there is no commitment, there is no amount which has been fixed, and so on. Now, if the customer asks for a latte, then the Joe, we use the Starbucks representative over here, delivers that, then you can record the revenue, because now the transaction has taken place and both parties have done their part of, or completed their part of the obligation. So expense recognition involves two steps. You identify the expense incurred during the period, and you must recognize them in which those expenses have helped to generate that particular revenue. So there has to be a matching of the expenses of a period to the revenues of that period. So here is an example. A customer pays Starbucks $250 on March 15 for coffee to be served at a party in April. Has Starbucks earned the revenue on March 15? Or when will the Starbucks earn the revenue? So again, there's a time gap between when the cash is received and when the Starbucks has performed its obligation. So when the cash is received, Starbucks cannot recognize the revenue, and it will earn the revenue when it has delivered the product to the customer. Transaction 2 says Starbucks pays $6,000 on July 1st for the store rent for the next 3 months. So basically it is $2,000 per month. Has Starbucks incurred an expense of July 1? Again, in this case, no, because it has paid the cash for rent in advance. They have not used up the advance, so it is like a prepaid rent for which the Starbucks will receive the benefit in the future 3 months. When there is that time gap between the cash and the actual recognition, you will need to make the adjustments, and that adjustment refers to the adjusting entries. Journal entries are made to ensure that revenues and expenses are recognized in proper accounting period, that is to match the expenses of a period to the revenues of the period. Generally, adjusting entries are made at the end of the accounting period. And third, they include at least one income statement account and one balance sheet account. But also remember, when you make an actual adjusting entry, you will not see cash in that adjusting entry because it does not appear when you make that adjusting entry, because the cash has been already received or it will be paid later. Now, the next question is, what are the accounts that will need to be adjusted? We'll probably provide some information on that. There are 3 basic categories of adjusting entries that are needed. One is called the deferrals, second is the depreciation, and the third is the accruals. So all the adjusting entries can basically fit into these 3 categories. What are deferral? A deferral is an adjustment for payment of an item or receipt of cash in advance. Deferrals are like prepaid expenses or unearned revenue. For example, you buy, suppose you are a Steelers fan and you buy the season ticket for Steelers game for $5,000 for the year. Now, when you bought this before the season started, it is an unearned revenue for Steelers. They have received the money, but they have not delivered the services, so they have not earned the revenue. Similarly, in terms of depreciation, depreciation allocates the cost of an asset like a plant over the asset's useful life. So if you've got an asset which will last you for say 10 years, or you bought a car which might last you for 5 years, then you write the cost of that asset or cost of that car over 5 years in terms of depreciation. Accruals is the opposite of deferral. For an accrued expense, the company records the expense before paying cash. For an accrued revenue, the company records the revenue before collecting the cash. So in a prepaid expense, it is the cash payment is before you record the expense. For example, you may prepay for rent, supplies, insurance, advertising, and then later on record the expense. So the first entry is recorded for the cash payment, and second entry for the expense when it is incurred. So here is an example. Suppose Freddie prepays 3 months store rent, that is $3,000 or $1,000 per month in advance on June 1st. So it pays $3,000. Two accounts that are involved are prepaid rent for $3,000, and since the cash is going down, it is credited by $3,000. If you are to record it in the T accounts, prepaid rent, which is considered as a current asset, is debited, and your cash is credited, which is also a current asset, and it is going down. So in this case, please note there is no expense that has been recorded on June 1st, and the rent is $1,000 per month. What happens on June 30th? On June 30th, you have used up 1 month's worth of rent, that is $1,000 worth of rent. So you have incurred a rent expense of $1,000, and you no longer have the prepaid rent for 3 months now. You only have it for 2 months. So your prepaid rent is now credited by $1,000, and rent expense is debited for recognizing rent for $1,000. Please note, now your prepaid rent balance is only $2,000 that goes to the balance sheet, and the rent expense is charged to the income statement. Suppose Freddie pays cash for $700 for cleaning supplies. So there are supplies they purchased for cash for $700. Supplies of $700 is purchased. Supplies is like an inventory or as an asset. So when it increases, it is debited, and when it decreases, when the cash decreases, it is credited. Now in this case, the entire supplies may not be used. So at the end of the month, you see that there are $400 of supplies on hand. So what happened to $300? It got used up. So in that case, you record the supplies as a expense, supplies expense debited, but at the same time, you no longer have $300 worth of supplies. So your supplies balance will now go down to 400, which is 700 minus 300 to 400, and your supply expense would get debited by $300. So now here is a question for you to do. At the beginning of the month, you purchase supplies worth $5,000. During the month, at the beginning of the month, there were supplies on hand for $5,000, and additional $7,000 worth of supplies were purchased. So now you got $12,000 worth of supply. At the end of the month, $3,000 worth of supplies were still on hand. So what is the adjusting entry? So if in this case, you have used up $9,000 worth of supply, that is 5,000 plus 7,000 minus 3,000, and therefore your supplies expense is debited by 9,000, and supplies is credited by 9,000, and still on hand is $3,000. Coming to the second category on depreciation, you record depreciation on assets like land, building, furniture, as the value of the asset decreases over its useful life. So it is allocating a cost as an expense for that long-term asset. The journal entry to record this is when you purchase an equipment, for example, for $24,000, you have got $24,000 debited, and since it is purchased on account, that is, cash has not been paid, your accounts payable is credited for $24,000. And now I'm pretty sure you understand the recording in the T accounts. Freddy's equipment has a useful life of 5 years. Now it has, after that it will be worthless. If it had some residual value, then we can subtract that from 24,000. So what we do is, if you are doing the straight line depreciation, you take $24,000 and divide by 5. So the expense for this year is $4,800. In case there was a residual value, you could have subtracted that from depreciation, or from the cost, and then divide by 5. So in this case, your depreciation is $4,800 for the year and $400 for the month. So if you have to record the depreciation for the month of June, it is recorded as depreciation expense debited, because your expense is increasing by $400, and you have got a new account called accumulated depreciation account on equipment. Now, accumulated depreciation account is a contra account. It is contra to the asset account in this case. That basically means it is opposite in nature to the asset. All your accumulated depreciation over the period will get accumulated in the accumulated depreciation account. So as far as the entry is concerned, you got depreciation expense to accumulated depreciation expense. Now, as far as the accumulated depreciation account is concerned, naturally, since the depreciation accumulates in that, the balance in this balance in the account will increase over a period of time. And since it's a contra asset account, it will have a normal credit balance that is opposite to what an asset balance has. A contra account has two distinguishing characteristics. That is, it always has a companion account. So in this case, equipment less accumulated depreciation on equipment, and its normal balance is opposite to the main companion account. So in this case, your asset would have had the debit balance, but accumulated depreciation has the credit balance. How do you show that on the balance sheet? And you've got equipment of 24,000 less accumulated depreciation of 4,000, giving $400, giving you at the end of the period book value of the asset at $41,600. So at the end of July, what will be the book value? In this case, that $41,600 is the book value at the end of June. For the month of July, you will have another additional depreciation of $400, so your book value will go down to 23,000. So your new accumulated depreciation, your book value will go down to 23,200. Yes. Similarly, you can have asset depreciation on other assets as well. Coming to the last category, we have got the accrued expense. In this case, expenses are recorded before the cash payment is made in terms of, say, salaries expense, or taxes. So you record them as expense first because they have already been incurred, and then you are going to make a payment for those expenses. Suppose employee is paid $1,800, half on the 15th and half on the last day of the month. and suppose the time or the calendar for the month of June shows you it is on 15th in June and 30th of June. So in this case, it occurs, the 30th of June occurs on Sunday, so Freddie will be paid on next working day. So in the month of June, for the first half, they paid a salary of $900. So that's simple. You got salary expense and you paid cash of $900. And you understand how to record the entry. Next is, since the remaining 900 will be paid on July 1, but you have to make the entry on June 30th. On June 30th, you'll record that expense or recognize that expense that has taken place in the month of June, which will be salary expense debited for $900 and then salary payable, a current liability, credited for $900. In case of accrued revenues, you record the revenue before you actually get the money. So, for example, services performed in case of rent or in case of interest, it might happen that you are getting the cash later, but you are recording the revenue whenever it has taken place. So on FedEx hires Freddie's on June 15th. They'll pay Freddie a $600 monthly with the first payment on July 15th. So for the month of June, what do? So during June, Freddie's will earn half a month's fees for the work done from June 15th to 30th. In terms of receivables for the half month, you've got $300 where you will spend the time later. So in this case, you've got the account receivable debited to service revenue. So in this, you have not received the cash, but the right to receive the money. And you can record that in a ledger account. So here's another example. Suppose you hold a notes receivable as an investment. At the end of June, $100 of interest revenue has been earned. What is the revenue adjustment at the end of June? So at the end of June, $100 is the interest receivable which has not been received, and interest revenue of $100 is also recognized. For the unearned revenues, your cash is received before you record the revenue. Once again, in case of unearned revenue, you have received the cash first, even before you recognize the revenue. So it could be with respect to customer service or rent or an airline ticket, etc. So here's an example of unearned revenue. Home Depot engages Freddie's and agreed to pay $400 monthly for an oil change at Home Depot. Now, if Freddie collects the first amount on June 15th, the Freddie's records, how would the Freddie record this transaction? So in this case, you got the cash, $400, and unearned service revenue from Freddie because you have not delivered those services. So cash is debited and unearned service revenue is credited. Here's another example of unearned revenue. Now on June 30th, you had a $400 credit balance. During the last 15 days, Freddie's will earn one half of $400 or $200. On June 30th, Freddie's will make the following adjustment. So on June 30th, you earned half of the revenue. So please note that the service revenue is credited and unearned service revenue is reversed to the extent of $200, or it is debited for that matter. Similarly, you know how to post that into the service revenue to your account at a credit of $200 and the unearned service revenue of $200. So what we have seen, here is a summary of what we have seen up till now. In the prepaid, you pay the cash first. So first pay cash and record an asset, prepaid expense to cash. Similarly, in prepaids, when you record an expense later, and decrease the asset. So in that case, you got the expenses recorded first and prepaid is recorded later. Very similar to what we do in the unearned revenue. Cash, you receive the cash and record unearned revenue. So in that case, your journal entry is cash to unearned revenue. And when it actually converts to revenue, then your unearned revenue is debited and your revenue goes down. Revenue is credited because it is going up and you are recognizing the revenue. Generally, your unearned revenue, effectively, if you don't consider the days, the unearned revenue gets canceled out, kind of. But we don't do that because it is happening on 2 different dates. So as far as this chapter is concerned, as the accrual summary, again, you can have the accrued expenses and accrued revenue. So when you got an accrued expense, you accrue the expense and a payable, and then you pay that expense later. Second, if you do it as accrued revenue, then you recognize the revenue, but since you have not received the money, it is based upon receivables, and later on you'll receive the cash against those receivables. In summary, there are 2 purposes of the adjusting process. One, to measure income, and second, to update the balance sheet. Now, therefore, every adjusting entry will impact the revenue or expense, and second, an asset or liability to update the balance sheet. Thank you very much for your attention. This brings us to the end of the accrual accounting.